China's macro and Chinese export is really limited because the Chinese companies really doesn't export that much of those items to the U.S. So right now, the U.S. account for only 0.2% of Chinese solar panel export and less than 1% of the Chinese EV export. So in terms of the impact on the individual companies and also the overall Chinese export is really limited.
It may be limited, but at the end of the day, I wonder whether it impacts sentiment for U.S. investors investing in China. And to the point that Will was making, at the end of the day, the U.S. is increasingly still buying a lot from China on a monthly basis.
Well, we think if we look at the recent rally, it was really driven by the risk-reward of Chinese equities that is a lot more attractive compared to some other major markets, for example, the US and Japan. And we also see investors' sentiments picking up, also due to some macro developments on the Chinese policy front. And if we look at the foreign fund flows, right now the long-only managers, they tend to keep the Chinese holdings and reduce the holdings of other Asian markets when they need to meet the redemption requests. So we think this time around, the sentiment has really bottomed, and due to the recovery of the macroeconomic outlook, it's really stabilizing.
But are we certain this is long only? Because, you even just look at the 13 Fs that came through today. It's a lot of hedge that we're investing in China. We saw the tactical opportunity. We saw the bets that were placed, and now, we've reverted to the mean. But everyone watching is going to be asking, is this a base with which we can see, in your mind, a substantive increase from here, or are we going to trade sideways? Because even as we get the latest set of earnings, for every 10 cent, there's an Alibaba.
Well, right now, we still maintain a market weight on Chinese equities because we think the longer-term outlook, the longer-term growth concern, and the geopolitical concerns remain there. And it will keep some of the longer-term investors on the sidelines. But because of the recent development on the macroeconomic front and the pickup in investment sentiment, we do want to capture some tactical trading opportunities. So we did increase some holdings on individual stocks, and we maintain our strategy of focusing on alpha selection. So in terms of sectors, we continue to like the high dividend yield stocks, which will benefit from the SOE reforms, and the companies who are likely to show better earnings visibility in the near term, and also the companies who have demonstrated stronger capability to expand overseas.
What about property market issues? You think that the Politburo meeting shows a shift in the government's approach to property market, the fallout that we're seeing there. Do you think that there is a bottom in place now firmly in terms of how bad the news can get for property?
The recent development in the Politburo meeting is really quite important because the government mentioned they will study measures to digest the property inventory. And to us, that is a very important change because in the past, when the government tried to deal with the property issues, they tried to build more social housing to stabilize the growth, but that ended up increase the housing supply. But this time around, the government want to digest the housing inventory directly, so they are solving the supply issue directly. And even though in the near term, the impact on the property market will be limited because it takes time to come up with the actual policy and to come up with plans on what developers or projects are involved. But we think this signals a very important point that the policy tone on the property sector is changing.
But can I just really quickly ask you to that effect? Because, we've all heard the reports regarding the millions of homes that the banks are going to potentially provide financing for that's going to be driven by the SOEs and everything else. But is this the most effective deployment of capital? Because it does run the risk that if they're, carrying the burden, whether it's, the local governments and the like, and they are taking up all of this property, it then assumes that you are going to derive some kind of return on that property, some kind of yield on that property. And if prices continue to stagnate, then what happens?
So there are some potential measures to solve the problem, the property market problem now. So one plan could be the government buying the unfinished housing or finished but unsold property project from the developers and then convert that into social housing. Or in some city, they are already implementing that they are providing financial incentives for the consumers to upgrade their housing, to sell their first house and then to upgrade to a second house. So no matter how, it will provide some, it will solve the funding and cash flow issue for the property developers, and it will help to digest the property inventory on a national basis. So in some of the cities that are having some pilot programs, it is showing good progress. So we think it can provide investors some assurance that the property market is bottoming and it won't have a collapse of the property market in China.